So we were doing debt equity ratio. So let's start. Today we are going to be doing some questions on debt to equity ratio. The formula for this debt to equity ratio was debt by equity. What is debt here? Debt normally represents the amount which are owed to outsiders and which are of long term in nature. So normally it is a long-term borrowings and long-term provisions which comprise the debt. And what is equity? Equity is the amount which is owed to the shareholders. So shareholders fund represents equity. There are different ways on the basis of information given the question. We will use different formulas to calculate these two amounts. I've sent the question in the group. It is illustration number 41 in the textbook. Look at that. They have given calculate debt to equity ratio from the following information. So information given is total assets 1,25,000. Total debts or liabilities, that is external debts, they have given directly 1 lakh. And current liabilities is given as 50,000. Now, in this formula, what is debt I told you? The long-term borrowings and provisions. So, we have total debts given here and current liabilities given here. What is total debts? Total debts is nothing but the non-current liability plus the current liability, both the long-term and the short-term together. So, here total debts has been given. So, we have to find out this particular amount which would be the numerator. So, therefore, non-current liability would be, we take this to the other side, it will become from the total debts. If we remove off the current liability, we are left with the amount of debt. So, to find out the amount of debt for this particular formula, total debts given 1 lakh, current liability given 50,000. So you get rupees 50,000 as the numerator. Okay, clear? Everybody clear with this?
Yes.
Okay. Now the numerator receipt. Now equity part. Equity means whatever is owed to the shareholders. Now they have given total asset. You know in a balance sheet total of the asset is equal to total of the liability side. So total asset is total liability. From the total liability, if you remove off the total debt, the debt means they have given clearly, see external debts. So if you remove off this total debt, what will be left? What was owed to the shareholders? So using that, we will calculate equity. Equity would be the total assets, which is also same as total liability. From that, we'll remove off the total debts. That will give us the amount related to the amount owed to shareholders. So total asset is 1,25,000. Total debt is 1 lakh. 1,25,000 minus 1 lakh. So we get equity as 25,000 rupees. Write it here. So it is 50 by 25 or 2:1 is the ratio. Is that clear?
Done.
Very good. Now we'll go to the next one. I've sent it in the group right now. It's still going. Everybody done? I'll erase this.
Done.
Oh. The next question I've sent is illustration 42. Look at that. From the following information, illustration 42. Compute debt to equity ratio. What have they given? Shareholders fund. Under that they've given it comprises of equity share capital of rupees 2 lakhs. They've given surplus, that is balance in statement of profit and loss account, 1,50,000. And they've given long-term borrowings. Under that they have 10% debentures, rupees 3,50,000, and they have current liabilities of 1 lakh. With this information, we have to calculate debt to equity ratio. So write first the formula always. Debt to equity ratio is equal to what? Debt by equity. What is debt? The long-term amount payable to outsiders, external. So from this information we find 10% debentures is what is payable to the outsiders in the long term by this business. So here the debt is equal to 10% debentures. So 3,50,000. What is equity? Whatever is owed to the shareholders belongs to shareholder. Here if you see, we have shareholders fund comprising of equity, share capital and surplus. So that two together would form the equity. That would be 2 lakh plus 1,50,000. So 3,50,000. So it came to 1:1. Clear?
Done.
Done? Very good. Now I've said the next question, illustration 43. Look at that question. There's something different here. Let's see whether anybody of you are able to identify it. Long-term borrowing has been given as 5 lakh rupees. Long-term provisions 1 lakh rupees. Surplus, that is balance in statement of profit and loss account DR, is 1 lakh. Then equity share capital 2 lakhs and general reserve of 2 lakhs. Now do you see anything different in this question compared to the previous question?
General reserve.
General reserve, yes, it was not there. Other than that, in surplus, what do you see different? Anything different in that?
Maybe debitor.
Correct. Normally, surplus which comes on the balance sheet liability side is a credit balance. But when it is company form of organization, whether it's a debit or credit, we write it on the liability side under shareholders fund, under reserves and surplus only. The credit balance is a positive amount. Debit balance is a negative amount. It represents losses. Got it? Clear? Or shall I repeat it? Clear? So what is debt here? From the information given, we have long-term borrowing, long-term provision. So long-term borrowing plus long-term provision put together 5 lakhs plus 1 lakh, that is rupees 6 lakhs. So we got the numerator here. For equity, you have these three items. There is equity share capital, there is general reserve, but this surplus would be subtracted. Why? Because it is a debit balance. So it would be 2 lakhs plus 2 lakhs minus 1 lakh. That would be rupees 4 minus 1, 3 lakhs. So that is the denominator. So that is one main place where you can go wrong. You just read surplus and add it up and solve the question. That's all. The entire question goes for a toss. You have to always be careful if they have given things like debit or credit next to surplus in brackets. Normally it's a credit balance. So normally it can be treated as plus, but if DR is given, you have to remember that it's to be subtracted. Clear? Done? Done writing? Are you able to hear me? Rujula, Cheryl, Nandana?
Done.
Done. Okay.
Done, ma'am.
Okay. So next we will go to 46th illustration. I'll come back to 45th afterwards. We'll do 46th first. Illustration 46. I sent it in the group. Look at that. Calculate debt to equity ratio. There's a lot of information given. Like they've given the fixed assets, gross value as 6 lakhs. They've given you the accumulated depreciation of 1 lakh, non-current investments of 30,000, long-term loans and advances of 20,000. Then they've given current assets of 2,50,000, current liabilities of 2 lakh, long-term borrowing which represents 10%, debentures 3 lakhs, and long-term provisions of 1 lakh. Now here we have to calculate debt to equity ratio, which is debt divided by equity. Now debt calculation is quite simple. We have the long-term borrowing and long-term provision available here. So debt is long-term borrowing plus long-term provisions. 3 lakh plus 1 lakh. That is rupees 4 lakhs. That was pretty simple. Now for equity part, okay, for the portion of equity, how do we calculate? So many information are given. They have given the fixed asset, gross figure, accumulated depreciation. These are all under non-current asset. If you see, this is a non-current asset. This is subtraction from the non-current asset. Non-current investment is non-current asset. Long-term loans and advance non-current asset. And they are given a current asset. Actually, the total of non-current asset and current asset is equal to what? Who can tell me? What is the total of non-current asset and current asset?
Total assets.
Very good, correct. So, from these information till here, we are able to arrive at total asset, which is also same as total liability. Now, we have current liability and these two are non-current liabilities, long term. This is current liability. If we remove from the total asset, which is equal to total liability, the current and non-current liability, what would be left? In a balance sheet, we have non-current asset, current asset, total asset. That is equal to total liability. In that we have equity, the shareholders fund, non-current liability, current liability. So from this, if we remove off these two, what is left? The amount that we require now, equity. Correct. Got it? So now all we have to do is add all these. So non-current asset plus current asset minus the total of non-current liability and current liability we have to remove. So for this we'll calculate the individual information. So what is non-current asset? You have the gross block minus depreciation. To that we would add the non-current investment and long-term loans and advances. So that is gross block was 6 minus 1, 6 lakh minus 1 lakh of accumulated depreciation plus non-current investment was 30,000, long-term loans and advances was 20,000. So 5 lakh plus 50. 5,50,000 is the non-current asset we got. Now for current asset directly given, we can write that 2,50,000. From this, we are supposed to subtract non-current liability, which is a total of this. So we'll calculate non-current liability. Non-current liability is equal to long-term borrowing plus long-term provision, which is 3 lakhs plus 1 lakh. That is 4 lakhs. So 4 lakh is a non-current liability. Current liability directly given 2 lakhs. So this is 5,50,000 plus 2,50,000 is 8 lakhs. And this is 4 lakh plus 2 lakh is 6 lakh. So your equity is rupees 2 lakhs. Got it? Do you all understand this? Any doubt? Once you're done till here, let me know. We'll put this equity in the formula and get the debt equity ratio. Okay. Now we'll put this equity in the formula. Here we get 2:1. That's it. Now send the next question. Question number 47. Illustration 47 in TS Grewal. Can we start with that?
Yeah.
Now, illustration 47. Now see, if a balance sheet is given, from the following balance sheet of Defence Brokers Limited, compute debt to equity ratio. Equity and liability, shareholders fund, share capital, reserves and surplus. See, it's in bracket, which means it's a debit balance. In a company form of organization, we write it in reserves and surplus only, but as a negative amount. Unlike in our partnership, we used to write it on the asset side. Non-current liability is long-term borrowing, long-term provision. Current liability, short-term borrowing, trade payable, other current liability. Assets, non-current asset, property, plant, equipment, fixed asset, tangible asset, intangible asset, non-current investment. Current asset, we have current investment, inventories, trade receivable, cash and cash equivalent, balance sheet total of 32 lakh 50. Now that non-current investment, they have given trade investment, and current investment is government securities, other investment trade. Now we are supposed to calculate the debt to equity ratio. So write debt to equity ratio. So write debt divided by equity. Now what is debt here? Very simple when balance sheet is given. Just look at the non-current liability. What are the items we have? Long-term borrowings and long-term provisions. That's all. Those two amounts. 15 lakhs plus 2 lakh 85,000. That would be 17 lakh 85,000. That is debt. For equity, look at the shareholders fund. Shareholders fund given there. Share capital plus reserves and surplus. What is share capital? 15 lakhs. Reserves and surplus is a negative 2 lakh 30. So you're left with 12 lakh 70. So write that here, 12 lakh 70. Now reduce it to the lowest form. And tell me what you get. 1785 is to 1270. Calculate and tell me the ratio quickly. Done? Anybody got it? It comes to around 1.4055 goes on. So we can put it as 1.41 is to 1. Anybody got it? I'm still doing. Let me know once you're done. We'll go to the next question. Done, everybody?
Done. Done.
Now next I have sent the question, illustration 45. Going back to the question, illustration 45. See, look at that question. Here you have to state giving reason whether the ratio would increase or improve or decrease or will not change. They have given the debt to equity ratio is 2:1. First transaction is purchase of fixed assets by taking long-term loan. Now what is happening here? Your fixed asset is going to increase, which is a non-current asset increasing, which will not affect your debt to equity ratio. But at the same time, how are you financing that fixed asset? By taking a long-term loan. So long-term loan increases. Where do we classify long-term loan? In a non-current liability. So that increases. So this is a debt. This has an effect of increasing the numerator with no change in the denominator. So when the numerator increases without a change in the denominator, what happens to the ratio? The ratio improves or increases. Got it? Next one, sale of fixed asset. Book value 40,000 at a loss of 5,000. Here what happens? Here in this case, the sale of fixed asset. So fixed asset is going to go down. You're going to get money in the form of your current asset increasing. And this loss part. So fixed asset would go down by the book value. Current asset would go up by the sale value. And the difference between the book value and sale value is your profit or loss. So here there is a loss. So loss would be in your equity. It would have an effect on your equity. In the reserves and surplus, we have the calculation of loss going into your profit and loss account. There it will come. So that way equity would undergo a change. Got it? And being a loss, it's a negative amount, your reserves and surplus is going to go down, which means your equity goes down. Without any change in the numerator debt, your denominator is going to go down. So, what would happen to the ratio here? It would improve or increase. Everybody following or not? Come on, answer.
Yes, ma'am.
Okay, good. Others? Busy copying? I am going to the third now. Sale of fixed asset. Again, it's a sale of fixed asset. Book value is 40,000 for rupees 50,000. Here also what is happening? Fixed asset affected. It doesn't affect our debt to equity ratio. The money coming in, current asset affected, doesn't affect our debt to equity ratio. What is affected is the equity to the extent of the gain or loss. In this case, 40,000 book value sold for 50,000. So you sold it at a gain. There is gain on sale of fixed asset. Therefore, what happens to equity? It goes up. So numerator debt unchanged, denominator equity increases. When the denominator increases without any change in the numerator, what would happen to the ratio? it would decrease. Got it?
Yes, ma'am.
Next is issue of new shares for cash. Now what is happening here? Shares are being issued, money is being collected. So two accounts affected are your equity share capital, which is a part of your equity which increases. At the same time, your cash, which is your current asset, is increasing. The only thing that is affecting our debt to equity ratio is the increase in the equity, which is the denominator. So debt unaffected, denominator equity increases. So what happens to the ratio? Ratio would decrease. Clear? Done. Can we go to the next?
Done.
Next one is issue of bonus shares. Now you should know what is bonus shares. Now when the company is prospering, what happens is that it wants to share the prosperity with its shareholders. So it can do that by different ways. It can give more dividend. So it can declare more dividend, it can declare interim dividend and so on. But what happens is that when dividend is declared now, they have to pay money. So their bank balance would go down. So they are affecting their liquidity. So they don't want to do that. So without doing that, still, how can the company share its prosperity? It can do so by issuing bonus shares. And bonus shares, certain number of shares are issued to existing shareholders on the basis of their shareholding. Like for example, for every 10 share held, 1 share might be given as bonus share. So if you hold around 1000 shares, you will get 100 shares as bonus shares given to you. So from the date of the bonus issue, you were holding previously 1000. After the bonus issue, you will be a holder of 1100 shares. Without paying anything extra for those 100 shares, you are getting 100 shares extra. You are owning 100 shares extra. So that way they are giving you. But while issuing bonus shares, what happens? They are not paying money. Their liquidity is not affected. What they do is they take from their reserves, their accumulated profits, and they capitalize that. Means they convert their reserves into share capital. So if you know in shareholders fund, what do we have? Share capital, reserves and surplus. So from the reserves and surplus, they take out amount and they're converting into certain number of shares which is given to the people as bonus shares. So money is not going out, but still they're sharing the prosperity with the shareholders by issuing bonus shares. Got it? Is the concept clear, everybody? Clear or not? Otherwise, I'll explain again.
Clear now.
Clear? Rajula, Nandana? No response by?
Ma'am, it's clear. Clear, ma'am.
Okay, fine. Okay. So in this case, what is happening is from reserve surplus, amount is getting subtracted, becoming share capital. So amount within the shareholders fund, this is nothing but our equity. So within the equity change is taking place. So ultimately total equity remains unchanged and nothing else is affected. So in that case, debt is not affected. Equity changing within that with no ultimate change in the amount of equity. Therefore, what happens? There is no change at all in the ratio. Clear? I'll go to the next one. Next one is redemption of debentures for cash. So now in this case, what is happening? Debentures are being redeemed. And where are debentures? Normally, debentures are classified under which category? Who can tell me? Where do we classify debentures in a balance sheet of a company? Under what head? Anybody knows? Where do we classify debentures in the balance sheet of a company as per Schedule 3? Nobody knows?
I'm not sure.
Sure? Okay. Long-term borrowing. Just now we were doing long-term borrowing. 10% debentures. So, it is normally debentures are classified under non-current liability. Under that we have long-term borrowing. Under that note we write debentures and other different ways of borrowings. Okay, got it now?
Yes, ma'am.
Now, but when it is redeemable debentures, it is going to be redeemed say in different years. Or after a certain number of years, say after 5 years or 7 years or so. So suppose it is redeemable after 5 years. So in the 5th year, next year, 6th year, you are going to redeem it. So whenever that is a liability which is going to get paid within 12 months from the balance sheet date or within the operating cycle, then what do? We reclassify it under current liability, other current liability as current maturities of long-term debt. So, although debentures is a long-term borrowing classified as non-current liability, in the next year it is going to become redeemable. Therefore, it becomes payable within 12 months from the balance sheet date or within the operating cycle. So, whatever portion we are going to repay back, we are going to redeem, we would take it out from the non-current liability and classify it under current liability under other current liability. Therefore, whenever debentures are being redeemed, here they said redemption of debentures for cash. The long-term borrowing and non-current liability is not affected because already amount has been removed from there and for 1 year before redemption it has gone into current liability. So debt is unaffected because of this redemption. Debt, the numerator remains the same. At the same time, you're paying cash, which is current asset. So equity also not affected. It is only current asset being affected. So current liability and current asset being affected, it would affect the current ratio, not the debt to equity ratio. Therefore, on redemption of debentures for cash, the debt equity ratio, there is no change. Is that clear to everybody? Can we go to the next?
Yes, ma'am.
Next one is where they are saying, seventh one, conversion of debentures into equity shares. So probably they have issued convertible debentures. Those are the debentures which while being issued they have said that after that certain period those debentures will be converted to equity shares. So the creditors would become the shareholders of the company. So at this stage they are converted debentures to equity shares. Now you know debentures are debts of company and equity shares are part of our equity. So what is happening? You're converting debentures, means debentures is going to go down, means debt is going to go down. Whereas they are getting converted to equity shares. So equity shares is going to go up, means equity goes up. Now the formula is debt by equity. So debt is coming down and equity is going up. So what would happen to the ratio? Obviously with the numerator shrinking and the denominator expanding, the ratio would decrease. Got it? The last one is declaration of final dividend. So who declares the dividend? The shareholders. It is proposed by the directors, declared by the shareholders in the annual general meeting. So once it is declared, it becomes a liability of the company. So it is going to affect the current liability because it is payable. Under current liability and other current liability, you will have dividend payable. So current liability would increase. And from where do you pay? From your profits. So in your reserves and surplus, whatever amount you have, from that you are going to appropriate the amount equivalent to what the company is going to pay as dividend. So reserves and surplus is going to go down. So reserves and surplus is a part of our equity, which is a denominated debt by equity. So what is happening? Debt is unchanged and your equity is decreasing. So what happens to the ratio? With numerator unchanged, denominator decreasing, the ratio would increase. Clear? Done, everybody? Are you all done? Can we go to the next? Done? Can we continue? Is debt to equity ratio clear now with these questions? Kindly respond. You're all able to hear me or not? Cheryl, Rujula, Nandana? Nobody responding. Done. Very good, Mahima. Okay. Okay, I'm moving further. Now we are going to do the next ratio. With the debt equity ratio is done. So next one is the total asset to debt ratio. Now what is the formula? Very simple. Total asset to debt. So total asset divided by debt. Now what is total asset? You just add the non-current asset and the current asset. You get total asset. And what is debt? We have already seen the debt to equity ratio. Same thing, long-term borrowing plus long-term provisions put together. Now this particular ratio is expressed as a pure ratio. And what does this actually measure? It measures the extent to which debt is covered by the assets. So how much assets you have, so that you can use that to pay the debts. Higher the ratio, the safety margin for the lenders would be higher because there is more assets available, so debtors feel safe. Lenders would feel more safe. Low ratio indicates that there is more dependency on outside funds for funding the assets. Means the debts are more, then only you will have low ratio. Clear? Note this down quickly. Then we'll start with the question I've sent. I'll give you a minute. Please complete it.
Done.
Let's start. The first question that I've sent. Illustration number 48. See, from the following information, compute debt to total asset to debt ratio. They have given the long-term borrowing as rupees 3 lakhs. Long-term provisions of 1,50,000. Current liabilities of 75,000. Non-current assets of 5,40,000. And current assets of 1,35,000. Now we are supposed to calculate total assets to debt ratio. Total assets divided by debts. Now what is total assets? From this information given, if you see related assets, they have given non-current asset and current asset. We know the total of these two is what is total asset. So we take non-current asset, add to the current asset. 5,40,000 plus 1,35,000. So 6,75,000 is the value of our total asset. We get the numerator here. For debts, we know given information long-term borrowing and long-term provision. So debts is equal to long-term borrowing plus long-term provision. 3 lakhs of long-term borrowing and 1,50,000 of long-term provision. So that gives us 4,50,000. So write that here, 4,50,000. Cancel these zeros. Find out the ratio. 45 how many times? 45 times 450. 15 would be 52, 0, 4. Yeah, 15. So 1.5 is to 1 is the total asset to debt ratio. Clear, everybody? Let's go to the next one. Done? Don't repeat, write this. This is just for your understanding. Just write this in your solution. Can we start the next one? Illustration number 49.
Yes.
Illustration number 49. Look at that. The information given is shareholders' funds, rupees 14 lakhs. Total debts, that is 18 lakhs. Current liabilities is 2 lakhs. They want us to calculate total assets to debt ratio. So for that, the formula will write total assets divided by debt. Now for total asset, how do we find out? Now if you see, there is shareholders fund and total debts given. On the liability side, what do we have? Shareholders fund, non-current liability and current liability. This non-current liability and current liability together forms our total debt. So basically if we add these two, we are going to get the total assets. So total assets from this information would be the shareholders funds plus the total debts. That would be 14 lakhs plus 18 lakhs. So that is 32 lakhs. So we get the numerator 32 lakh. Then we need the denominator, which is debt. For debt, we are going to use these two information. They are given total debts and current liability. We know total debt is nothing but non-current liability plus current liability. So what would be debt? It would be from the total debts We'll remove off the current liability. We'll get the non-current liability or the debt portion of our formula. So total debts is 18 lakhs minus current liability of 2 lakhs. So you get 16 lakhs as your debt. Replace it here. So you get 2:1 as the total asset to debt ratio. Got it?
Yes, ma'am. Done.
Now I've said the next question. Let's do that. That is illustration number 51. Look at that. The information given is total debts is rupees 15 lakhs. Current liability is rupees 5 lakhs. Capital employed. This is a new term. That's why I selected this. It's nothing rocket science. Capital employed would be nothing but your shareholders fund and the non-current liability or the long-term borrowings and long-term provision or your debts put together. So it is equity plus debt put together, which becomes your capital employed. So all you have to exclude is the current liability from it. You have to calculate the total assets to debt ratio. So to calculate the total assets, what is capital employed? I told you capital employed is nothing but equity plus the debt part. So to get the total asset, we have to add something more to the capital employed. Because in balance sheet, in addition to capital employed, there is current liability also. So when you add that, you get total liability, which is same as total asset. So we'll take the capital employed here, 15 lakhs. Add to that the current liability of 5 lakhs. So we get total asset as 20 lakhs. Got it? Numerator 20 lakhs. Then we have to calculate the denominator debt. Debt here represents the long term. Here we have total debts and we have current liability. So to get the debt amount that we require, that is long term one, all we have to do is from the total debt, we'll remove off the current liability, we'll get the long term debt, which is 15 lakhs minus 5 lakhs. So you get rupees 10 lakhs. So 10 lakhs is the debt. 2:1 is the ratio. Is that clear? Clear or not? Let me know once done. I'll send the next question. We'll solve that. Done?
Done.
Next question I've sent. Have a look at that. Illustration number 55. Fixed assets gross amount given at 10 lakh rupees. Accumulated depreciation given at 5 lakhs. Non-current investments at 50,000. Long-term loans and advances given at rupees 2 lakhs. Current assets given at rupees 2,50,000. Current liabilities given at 10 lakhs. Long-term borrowing rupees 3,25,000. Long-term provisions rupees 2,75,000. Calculate total asset to debt ratio. So total assets divided by debt. Now so many amounts given. Don't worry. First classify them. Fixed asset minus accumulated depreciation part of non-current asset. Non-current investment is non-current asset. Long-term loan advance, non-current asset. Current asset given to us here. Current liability given here. Long-term borrowing is non-current liability. Long-term provision is non-current liability. Now using this information we will calculate now. What is total assets? Total assets we know is non-current asset plus current asset. We have classified here. We have to just add all these. So first non-current asset we'll find out. It is fixed asset minus accumulated depreciation. To that we are supposed to add the non-current investment and long-term loans and advances. So non-current investments plus long-term loans and advances. So fixed asset minus 10 lakh minus accumulated depreciation of 5 lakhs plus non-current investment of 50,000 and long-term loans and advance of 2 lakhs. So what happens here? 5 lakh plus 2 lakh 50, 7 lakh 50,000 we got. So 7 lakh 50,000. Current asset directly given 2 lakh 50,000. So what happens? Total asset is 10 lakhs. Is that clear?
Yes, sir.
Now, for the debt part, we know debt is the non-current liability part. So long-term borrowing and long-term provision. So how to calculate debt? Debt is long-term borrowing plus long-term provision. So long-term borrowing is 3,25,000 plus 2,75,000. So that comes to 6 lakhs. So replace it here. 10 is to 6 or 5 is to 3 or further you can reduce it. It would be 5 divided by 3. 1s are 3. 2.6, 18, 2. So it will go as 1.666. So it would be 1.67 is to 1. Always reduce it to the smallest form. Got it? Clear?
Yes, ma'am.